Hello and welcome back, Advanced VITA volunteers. Today we are going to be delving in a little bit deeper into the standard deduction and tax computation lesson. We're going to be going beyond just talking about the standard deduction and how TaxSlayer calculates the tax based on the IRS tax tables, which is what we focused mostly on in our basic lesson about the standard deduction and tax computation. This time we're going to talk a little bit about Kiddie Tax and the Qualified Business Income Deduction, which is not exactly the standard deduction, but it is one of our other what's called below the line deductions, and the line refers to adjusted gross income. So these deductions come after we've gathered together our income and subtracted out our adjustments. So in our last lesson, we briefly covered the standard deduction for dependents, and we didn't delve real deep into it, but there is this worksheet, and of course this is something that TaxSlayer figures out as long as we are checking the box in the basic information screen in TaxSlayer that says that this is a dependent's return, that somebody else can claim this taxpayer. So they may still be filing and they may need to file, but they will be claimed by somebody else, in which case they have some different rules and different thresholds for their standard deduction. And if they have earned income, it's their earned income plus $350 as long as it's below the usual amounts. But if they have unearned income, then their standard deduction drops way down to $1,100. And so we're going to talk a little bit about how unearned income for dependents can cause some other interesting tax consequences and ways in which the tax will calculate. And just to review, unearned income as opposed to earned income is things like taxable interest, ordinary dividends, capital gains, rents and royalties. Social security benefits that are taxable would be considered unearned income. Pensions and annuities, taxable scholarships and fellowship grants that aren't reported on a W-2. If they are on a W-2, they would be considered earned income, but if they aren't reported on the W-2, then they would be considered unearned. And then unemployment compensation is unearned alimony, income received from as the beneficiary of a trust. And then a couple more specific ones that we're adding into this discussion are Native Americans receiving per capita payments and Alaska residents receiving permanent fund dividends. And both of those are types of income that will come in on a Form 1099 miscellaneous in box 3, other income. So the connection that we're making between dependents and unearned income has to do with this, what's called a Kiddie Tax, which is an informal name. This is just a child's unearned income that may be taxed using their parents' tax rates if it was more than a certain ceiling amount, which we'll talk about. In order to determine if we're doing a return that looks like the Kiddie Tax is going to apply, all of the following need to be true. The child would be required to file. So again, if they have earned income, they have their earned income plus $350, or if they have only unearned income, is it over the $1,100, then they would be required to file. And then also the child's unearned income needs to be more than that ceiling amount, which we keep dropping that term, and I promise we're going to explain it. And then there are some other requirements that have to do with age and some other conditions, but we'll talk about that in a couple slides. So as promised, here is the ceiling amount, and this applies to unearned income only. So first we take the standard deduction, which is $1,100, and then we add in another $1,100, so we match it, of taxable unearned income, gives a total ceiling amount of $2,200 for the year 2021. And so if this child has unearned income under the $2,200, they will not need to pay this kiddie tax, the tax at the same rate as their parents. If they have unearned income over that amount, then we are looking at a tax based on their parents' tax rate. And then here are the other conditions that apply, the age and other kind of related conditions. So for age, we're looking at, was this child under the age of 18 at the end of the year? Were they age 18 and then didn't have earned income that was more than half of his or her support? Or were they a full-time student, at least age 19 and under the age of 24 at the end of the tax year, and did not have earned income that was more than half of their support? So thinking about that situation for those scholarships and fellowships that are considered unearned income. So then the other conditions for this would be that at least one of the child's parents is alive at the end of the year, and the child is not filing a joint return for the tax year. So if this child does end up being subject to the kiddie tax, then we're going to be looking at Form 8615. That's where this income is going to flow onto the return to determine what the child's tax rate is going to be based on what their parents' tax rate will be. And you'll see this is really called the tax for certain children who have unearned income. Kiddie tax is a lot more snappy and catches your attention. So for VITA, it is important to note we do have very strict scope guidelines. The only times that we would be preparing these returns would be for Native Americans receiving the per capita payments and the Alaska residents receiving the permanent fund dividends. Again, these are reported on Forms 1099 miscellaneous in box 3 as other income. Any other situations involving the tax for certain children who have unearned income are going to be out of scope, and we would need to be sending those taxpayers to a paid preparer. So that last form we were looking at, the Form 8615, attaches to the child's tax return. On the other hand, parents can elect to report a child's interest and dividends on their return so that the child does not need to file a separate tax return. And they can do that, the parents can do this, on Form 8814. So this would attach to the parent's return. There are up in the top of the form, it has a caution just letting the parents know that this may not be the most beneficial way to file the taxes. That the child might have certain other benefits that make this this income, reduces the tax on this income. But parents might choose to do this if none of the situations that would reduce that tax would apply, or if it's just easier. So this form here is in scope only for Alaska residents receiving the permanent fund dividends. So now that we went on a whirlwind through the kiddie tax, let's talk about, we'll shift gears a little bit and talk about the Qualified Business Income Deduction. And so I just wanted to show you, the front page of the 1040. This is page 1, and we've cut out a little bit of the middle material here. We have line 12A is where the standard deduction or itemized deductions will go. And then line 12B, I think we just briefly talked about this in the basic lesson. There is a charitable contributions deduction for people who are taking the standard deduction. This is was special last year, and it has been continued into the year 2021. And then after that, we have the Qualified Business Income Deduction, which flows from Form 8995 or Form 8995A, which we'll look at a little bit later. And you'll notice that once we get, these below the line deductions, the standard deduction, that charitable contributions, if it's applicable, and the qualified business income deduction, we subtract those out of that adjusted gross income, and we get to the taxable income, which brings us to the end of page 1. So in brief, qualified business income deduction, or the QBI deduction, is the lesser of these two situations. Situation 1 is 20% of qualified business income plus 20% of qualified REIT, which means real estate investment trust dividends. Those are also called Section 199A dividends. So the business income for our clients is going to be flowing from Schedule C, and then those REIT dividends will be flowing from Form 1099 dividends. So you might see a QBI deduction on a return that doesn't even have a Schedule C. So just be aware that that would be flowing from a 1099 dividend form if you need to, retrace the steps through the return to make sure that things have calculated correctly. TaxSlayer does calculate this as long as we are putting our entries in correct. So the situation 2 is if the taxpayer has a taxable income that is lower than their qualified business income deduction, or than their qualified business income, which happens because we might have other capital losses, or we might have adjustments to income that lower the taxable income to a lower amount than what the qualified business income was. So if that's the case, then the QBI deduction is limited to 20% of that taxable income, which is calculated as the adjusted gross income minus the applicable standard or itemized deductions. So those come out of that calculation as well. So they can have that 20% of taxable income, but they also have to subtract out their net capital gains and qualified dividends. And if you remember, capital gains and qualified dividends both are taxed at a different rate, a lower capital gains rate for the purposes of tax. And so they have a different tax rate than ordinary income. So this qualified business income deduction applies specifically to the ordinary tax rate. So when looking at the QBI deduction, it's also important to note that it is the qualified business income that's reduced by the deductible part of the self-employment tax, the self-employment health insurance deduction, and certain contributions to certain qualified retirement plans, not the traditional IRA deductions. These are other types of plans that have to do with usually, the self-employment income. But so you can't just necessarily look at the net income from the Schedule C and take 20%, and that's for sure going to be that QBI deduction. You also have to look at these other adjustments that don't show up necessarily on Schedule C, but they show up in the adjustments section. And then more for awareness than anything, the Qualified Business Income Deduction does have some limitations for higher income taxpayers. And what that means is for single taxpayers, $164,900, from married filing joint, $329,800. So these incomes are quite above where our clientele are going to be, and really they're out of scope for VITA altogether. But if a taxpayer had that high of an income, it would be important to know what kind of trade or business that they are working in, because there's some specified service trades or businesses, which in short are things like accountants and lawyers, and some others, healthcare, etc., that would have either be disallowed from taking this deduction, or they would be limited from taking it. But again, this is an out of scope issue. It's just good to note that there is a limit there. And these are our forms 8995 and 8995A. It's where the QBI is calculated. You won't see both of these on a return. You would just see one or the other. And for our clientele, we're really going to be looking at the 8995, the simplified computation. You'll notice up in this grid here in the top portion is where the taxpayers' services and businesses are listed out. So if they have more than one Schedule C, you would see them listed there, and then they get aggregated together, and the deduction gets calculated from there. In the bottom portion, there is a line, line 8, and that's where the 199A dividends from a REIT that get reported on that 1099 dividend form, those flow onto this form on line 8. And then it's also good to note how the information flows through the return, how these numbers are going to flow through the return. So numbers flow from Schedules C and SE onto the forms 8995, but they do not flow the other direction. So when you are looking for this QBI, you will not find it on Schedule C or Schedule SE, and they don't affect those calculations. But information from those do flow on to the 8995, and from there it flows on to the front page of the 1040. So now that we've discussed our advanced topics in the standard deductions and tax computation lesson, we talked about the Kiddie Tax and we talked about the Qualified Business Income Deduction. Here's what I want you to do. In this case, we are not going to head on over to Link and Learn because there aren't any skill check questions based on these topics. If you would like some practice with some questions, publication 4491, again, the lesson is standard deduction and tax computation. You'll find within the lesson some questions, and the answers will be at the end of the lesson. In TaxSlayer, we have a return with a Schedule C that's going to result in qualified business income. And then, as always, remember your resources. You have publication 4012 and 4491 available to you anytime during training, during the open book exams, and in the field.